So, welcome to a new topic for the series. And as I have promised, we are going to answer the question, what will happen if you or your company cannot pay the liabilities in its due date as promised? Well, what might happen is the debt restructuring. But before we start talking about the topic, let me tell you in advance that the main goal of this video and the next videos is to answer the question, how to account for debt restructuring? Or stated differently, what will be the accounting for debt restructuring? Okay? But before that, please see the previous episodes because what we will be talking about here is very much connected with the previous episodes. So their links are on the description below. So again, don't worry because those previous episodes are very short. And if you already did that, then let's get started. So guys, if you or your company can't pay your liabilities in the due date, maybe because of financial difficulties or else problems on the timing of your cash inflows, remember, you can always ask the creditor to restructure your debt agreement. Okay? And actually, you can ask the creditor about modifying the terms of your agreement. Like, you can ask to change the maturity date or term because sometimes you don't have any money upon due date, but you are sure that you can still pay because there might be an inflow in the near future. Like for example, if you have a liability which will due 1 year from now, but you are sure that you cannot pay in that time, then you can ask the creditor for extension of maturity date to after 2 years or after 3 years. So that's just an example. And actually, you can also ask the creditor to lower the amount of principal to be paid. Like for example, instead of paying 5 million principal, which is in the original agreement, you can request for a smaller amount like 3 million or 2 million. And you can also ask for a smaller interest to be paid. Or you can ask for all of the three. Well, these are under the modification of terms, which is just option number one for you if you don't have any money to pay at due date. So you have option number two, which is you can pay non-cash assets instead of cash. Like you can pay property or machinery or equipment, and that is what do we call the asset swap. Okay? And we have option number three, which is instead of paying cash, you can give the creditor shares of stock of your company. So here, the creditor will become one of the shareholders already or owners of your company instead of being a creditor. And that's what do we call equity swap. Okay? Now, option number four, the creditor can even forgive your debt. So, you as the debtor will not pay anymore. Now, those things that I've mentioned, these 1 to 4, are the debt restructuring options. Now, we are going to talk about the accounting for those debt restructuring options, which will start with the modification of terms. And we are going to do that later. So, let's have the modification of terms, which is again talking about the changes in the maturity date or term, changing of principal amount to be paid, and the changing of the interest rate. Okay? Now, to make it more meaningful, let's connect the past sample problem with this lesson. Okay? So let's have first our completed timeline here. Now, let's assume that baby G is the debtor in the previous sample problem, has paid its obligations from year 1 to year 3. So that's from here to here. Meaning, there is no accounting problem from here to here. Now, let's go to the problem. But BBG suffered from financial difficulties. So, it negotiated with Baby M, the creditor, to change the terms to the following. So, the remaining undiscounted principal of 2 million will be paid 500,000 each year at the end of year 4 at the end of year 5, year 6, and year 7. Well, as you can see here in this timeline, Baby G is supposed to pay in the future 1.2 million at the end of year 4 and 1.1 million at the end of year 5, right? Now, in this 1.2 million, we know that 1 million is for the principal and 200,000 is for the agreed interest payment. And this last payment of 1.1 million, 1 million is actually again the principal payment, and the 100,000 here is the interest payment. So, the unpaid undiscounted principal is 1 million here at the end of year 4 and 1 million also at the end of year 5, or 2 million. And it's mentioned here. Now, Baby G, since it is suffering from financial difficulties, it negotiated with Baby M, which is the creditor. So, it said that the 2 million shall be paid in 4 annual installments of 500,000, making the maturity term extended. Because instead of fully settling the liability in the next 2 years, it will now be settled in 4 years already. And the amount of principal payment per year was reduced to 500,000 instead of 1 million per year. So that's the meaning of this line. And I hope it's clear. Now, aside from that, Baby G also requested for a reduced agreed rate from 10%, because that's the agreed rate or nominal rate in the original sample problem, if you can still remember. That 10% will be reduced to 8%. So, that's the sample problem in the past, but it is now revised to suit our current topic. Okay? Now, let's assume that BBM, the creditor, agreed to all of this. And actually, that's the assumption when answering problems related to debt restructuring. And again, the assumption is the creditor agreed with the new terms. Now, it's time to compute the total payment every year at the end of year 4, year 5, year 6, and year 7. So, as to principal, Baby G have to pay 500,000 each year. But, as to interest, it is based on the outstanding balance. So, on the end of year 4, the 8% will be based on 2 million. And on the next year, the 8% will be based on 1.5 million already, because the 500,000 has already been settled at the end of year 4. Okay? Now, at the end of year 6, the 8% will now be based on 1 million only. And at the end of year 7, the 8% will now be based on the 500,000 remaining balance. So, the interest payments, if summarized, are 160,000 for the end of year 4, 120,000 at the end of year 5, 80,000 at the end of year 6, and finally 40,000 at the end of year 7. So, because of that, the annual payments will be principal plus the interest for year 4 to year 7 is 660,000, 620,000, 580,000, and finally 540,000. Now, based on this particular problem, let's answer the question, what will be the accounting for this modification of terms? But let's do that on the next episode to keep this video short. Okay? So if you've learned, please click like, subscribe, and hit the notification bell and select all to be updated on my next videos. So again, thank you for watching and see you on the next one.